Welcome to TMS Insights. Jeremy Hook and Ben Clark bringing you an October update. There's been quite a bit going on since we last communicated after the reporting season. Ben, we've lost about 300 points on the ASX 200, which is quite a bit over that 5-week period. There is a bit of concern. It's not unusual this time of year. Some of the factors include a sell-off in China, midterm elections coming in the US, bit of overvaluation in some growth stocks. How have you seen the last month?
I think that sums it up well, Jeremy. We've also had the Royal Commission into the banks, of course, and we've had some slight reductions in their earnings numbers, which have been a drag on the overall market. But look, I think we hit a 10.5-year high when we're at 63.50. Corrections in a building market are healthy and pretty normal. And we normally do see that this second half of October, you see some pretty good strength in the market. It doesn't happen every year, but a lot of dividends hitting bank accounts at the moment, which will start to get recycled back into the market, particularly as valuations start to look a bit more appealing.
Now, you mentioned banks. We shouldn't leave that without further comment. Obviously, the Royal Commission findings are hurting. There have been a lot of refunds made that have been provisioned now by the banks collectively, and we will hear from them about their full year reporting in a couple of weeks' time.
That's right.
They'll pay dividends there before Christmas, so there's a bit of activity going on there. Just for our viewers, are they still really that ex-growth sector that pays really good dividends and nothing more?
That's what they are. I think, and I don't think either of us have changed our view on the banks for a couple of years probably now, where we're going into an environment where earnings are forecast to be pretty flat for some time. The dividend yields, though, are looking actually more sustainable, ironically, as the banks continue to clean up their businesses. I think in terms of funding retirements and looking for good, safe dividend yields, and you probably have to say pretty cheap prices now. A lot of the bad news, I think, is largely priced in.
And I'd like to quantify the numbers we're talking about in terms of what their provisioning is. Relatively low compared to market cap. Net profit for a full year.
I think, in the upcoming earnings season for 3 of the big 4, we're likely to see earnings per share drop maybe 2 to 3% versus a year ago. So you need to keep it in perspective. And the banks have had a rotten year. And to me, it shows the strength of their businesses, that the earnings are so resilient despite all the headwinds that they're facing at the moment.
Yeah, I'd agree with that. Big news from another of the bigger stocks on the market. Wesfarmers has released the information memorandum about the Coles demerger, which is subject to a vote in November. So we'll have that finalised, we believe, in about 6 weeks' time. What do we make of this? I mean, Coles is been loaded with $2 billion of debt, a bit more than what we thought. Does this just make Woolies look okay? Yeah,
I think like a 250-page fund document to read. It's pretty crazy. But look, I'm sort of in two minds about this one, because the reality is that I reckon there's a very good chance that a demerged company will go on to outperform the parent. We've just seen it happen so many times historically. But I do think that Coles, from what I see, is in need of some capital expenditure. It's fighting against a much better, stronger competitor in Woolies now. And my probably take out of it is this is a good thing for Woolworths, who are going to be fighting a competitor with not as deep pockets, who need to spend money. And Woolworths, I think, are at the top of their game again. And it's probably good for both. I think the pricing pressures we're seeing in this industry might start to drop away. But I think Woolies is the winner out of it all.
Good one. Just in terms of earnings updates, we heard this week from Invacare. We always have a funny sort of discussion about this stock, but case volumes being down. Everywhere else, good news, but it's not good for their profitability.
That's right. I mean, actually, despite the market being quite weak, there's been very little company announcements that have... So I guess it's another reason we're not feeling too worried about the market at the moment, because there hasn't been any deterioration in any fundamentals. Invacare is one that has had one, but it's a very cyclical deterioration. A very benign flu season and a very mild winter on the East Coast has seen the death rate actually deviate, I think, the most we've ever seen it from the projection. But unfortunately, that'll catch up. And Magellan was another one who had their AGM, first in the AGM season.
Wow. And got really kicking along. We'll get some good news from companies of that kind. They're making a lot more gains than their peers in that funds management space.
Absolutely. $70 billion plus and counting now. Like Hamish Douglas moving out of the CEO's role and purely to investment, I think is a good win for them. And a great dividend yield. It's it's almost on the same yield as the banks.
Yeah.
But a growing business.
And just before we leave that pullback, the growth stocks that have come back, there's some great names that have come back reasonably large percentages. Do we just put that down to a previous overvaluation that's coming back to the market?
Yeah, I think so. Inevitably, at some stage, there's going to start to be some profit taking, and I think that sort of steamrolls itself a bit. Again, no change in fundamentals. In the short term, a lot of these share prices probably got a bit ahead of themselves. But then I was saying that 6 and 12 months ago. So, you got to put it in perspective, I guess, of where they've come from. And they could easily come back a bit further, I suspect. But as long as the long-term fundamentals are there, still a good place to have some money in your portfolio.
Good one. Now, Rio launched an off-market buyback, which is certainly something we've been interested in over the past, and this one as well. For those in pension phase, it can certainly be very, very valuable. That's going to come up. And certainly one that you would want to be taking up for people, so that's good.
Yep.
Ben, this kind of concept, though, strikes at the heart of what's going to be a real rush for franking credits.
Yes.
The franking credits are really topical at the moment.
Yes. Look, I mean, obviously Bill Shorten is proposing at this stage that franking credits will go. It's going to have an enormous impact on most of our clients.
Franking credit refunds.
Franking credit refunds. Right. And... we think this is crazy. I think the policy, it's that the craziness to me is that this actually has an impact on the people he's saying it won't have an impact on. And ironically, people who have got very large super fund balances will still be able to utilise their franking credits. And it's really more a direct attack on the middle class.
So we know that Jeff Wilson, leading fund manager, has led a bit of a charge for a petition, which we encourage people who are interested in this cause, and we think it's a lot of our clients and viewers to sign up to the petition. The link is with the email attachment to this video, so hopefully that gets somehow reduced if a Shorten government is elected, Ben.
Yeah, look, I think if enough people sign up and forward on to friends, etc., it could create a number of people who this becomes uncomfortable for Shorten. So hopefully we might see the proposals watered down or hopefully got away with entirely. So, get on board. I think it's the best way we found to probably try and express your opinion, and let's hope it helps make a difference. And
there is a parliamentary committee hearing cases on this, which we'll hear through the media over the next few months.
Yep.
Hopefully some resolution there. Well, that's all in the market from this TMS Insights video. We look forward to bringing an update in November.